Good afternoon, or evening, or morning, or whenever you're watching this. This is Tim Knight, Slope of Hope Blogmeister, and it has been, for the Bulls, a dynamite time recently. Just to put this in perspective, over the past 7 trading days, the boring old S&P via the ES has gone up 14%, if my math is right. We have here the final swoon that went into last Tuesday, and it actually broke support. And this, if you look just right, this is a giant middle finger the market is giving to everybody who thought the market would collapse at that point, because it did just the opposite. I've been doing this long enough to know about these little fake outs. As you may recall, when Tuesday ended, I was very pleased / relieved to have covered most of my shorts, because that would have been painful and extraordinarily painful over the past week or so to have held on to those things. And my rationale at the time was, bottoms-up trader that I am, a lot of my individual charts and a lot of the individual prospects really didn't look like they had a lot of juice left in them, and that was the case. There have been many stocks that have gone up 20, 30, 40, 50% in the past week. And so, oversold is a term I don't like to use, but it was oversold. It was oversold back then. This also has been, as far as the Dow goes, about 1,200 points in that same span of time. Here again, we have the breakdown, the breakthrough of support. Didn't mean a thing. Didn't mean a thing at all. But let's back up here. Let's look at the daily charts, which I am far more interested in. And I want to talk about sort of what I think might be next. Let's look at a few index charts here. We'll start with the NASDAQ Composite. Now, the NASDAQ has been within, all the indexes have been within a range of one kind or another. In this instance, we have been range bound since August 4, so that's about 10 weeks now. We are at the highest part of that range, exceeded only on September 20. Let's look at 3 possible ways this could go, because I don't, obviously nobody knows, no matter what they tell you, nobody knows for sure which way things are going to go. But let's look at some possibilities. Possibility 1, which seems the most likely, is that we will ease away from this level, because that's what we've been doing for the past 2.5 months. And frankly, possibilities 1 and 2 have the same beginning but different ends. So possibility 1 is that we go down and ease down, and for whatever reason, go back down to the bottom of this range. I don't think it'll be that simple. That's just too clean. The trading gods, I don't think, are that kind. I'm entirely sure right now, so it'd be nice, but I don't think they're quite that kind. Possibility 2 is that we ease and then kind of stall in the middle. And that's when everyone, bull and bear alike, will be hating life, because it's really unclear at that point what to do. Bulls will be ticked off that their long positions are all underwater. Bears will be happy that they've made that much money, but they'll be a little bit nervous, because things could whip right around higher, taking everybody out. So prospect 2 takes us about into that middle of the trading range, and big question marks appear at that point. Bulls will see it as stocks are on sale again, and bears will see it as, well, things are just going to plunge down farther. I think it's most likely that we'll get here and no one will know what the hell comes next, and I'll be among them, because that's the nature of trading ranges. They frustrate and infuriate and puzzle and confound, and this one will be no different. And the third prospect will be that we break above that range. If we do, I think the easiest shot, it would be to the underneath of that red line, and it may, if it's really powerful, if they come up with some multi-trillion-dollar plan, and I put that in quotes, I guess we could get as high as the underbelly of that blue line. I really just don't see that as terribly likely that it would get that much strength beneath it. This, newsflash, this isn't a base. I mean, this is a range. This is not a base. So while we're here, I'll go quicker through the other indexes, but while we're here, because the story is kind of the same, I want to contrast this pattern with this pattern. Now, we all recall what happened back here. This was the Head and Shoulders that everyone was talking about. This was the God help us when, what was the guy's name? Anthony Robbins, of all people, came out and said, the world's going to end, the things are going to collapse. When people like Tony Robbins are waxing poetic on technical analysis, well, whatever, the opposite will happen. We can clearly see that. And the opposite did happen. This kicked off one of the most painful rallies I've ever endured. I think there are a couple of differences between this and this. Difference number one is that nothing had broken back here. I mean, the rally was still intact. And support, as we can see represented by this line, had not been violated. And so really the notion that things were going to drop from here was a hope, a slope of hope, if you will, that never transpired. I was as guilty of this as anybody else, more guilty, in fact. I was very heavily short back here and suffered mightily because of it. Big mistake. I would note that what we see here, things have already broken. We have dropped beneath what I consider fairly major support, and we have been range bound for one reason and one reason only. No one knows what's going to happen with Europe. Everyone's obsessed with Europe. We're all Forex traders now, and until Europe resolves one way or the other, we're going to continue to be Forex traders now. I don't like being a Forex trader, but that's what we are. Maybe earnings season will shake things up a bit, and we can focus on what stocks are doing, but that's that. So I don't think the bulls are in as strong a position as they were back in the summer of 2010. Let's look at the OEX, another major index, and a little clear definition of this. We can see here, here is the topping pattern, and the drop, and in the range now. I think that the market could ultimately go as low as the summer of 2010, this line that I'm pointing to right here. If it did, I would cover everything myself. I think it will take something very big next year for it to crack the lows of summer 2010. I am not greedy. I'm very happy for it to get as low as summer 2010's levels, that lower purple line. I think today wasn't a bad day to be entering short positions, because if I'm wrong, it will take very little to make it clear that being short is the wrong decision. Getting above this sort of line would be a pretty decent signal that the bears are wrong, and getting above this line would be just forget it. All bets are off. I mean, it's rally time again. The big boy, SPX, let's look at this one. A bit of the same idea. And here again, we see those sort of two levels. First one being here around 1230, and the next one around 1250. I would hope, not that it matters, that we stay beneath 1230. Makes trading a lot easier. And it is more than a little interesting to me that it seems like years ago, but just last week we were actually at the lowest level seen for a very long time, breaking beneath those August 8 lows. It was only last week. Let's remember that. Very easy to lose sight of that. So the market is suggesting that it has the prospect of being that weak. I think that's an important tell. Now, weakest of the week, I think, in spite of all the strength recently, is the world of energy. And I've got a pretty goodly sized short at this point on OIH. I was watching OIH carefully. I got stopped out on one trade because the gap got filled, and I've seen this in a lot of places recently where there was this gap and it got filled and then some. And so more important than that, I think, is this red trend line you see here. That red trend line was violated and has been retraced and almost to the penny. It actually has a little more space between the high today and the underbelly of that trend line, but that's okay if it doesn't get all the way to the top. But I'm saying that's a more formidable stop level. The gap was a nice little guide, but that's been filled in a little bit more. I would also note that from a candlestick perspective, this is a pretty nice shooting star pattern. The point I'm making in general, though, is that even in the midst of a surging euro and a surging equity market, energy, oil, has been really the relatively weak cousin. So if things start to fall, I think oil will fall the fastest. It wasn't lost on me either, looking at the OIX, that it couldn't even get back to its former support level here. Far from it. It broke beneath this line and has struggled to get even a portion of the way back. So again, energy being particularly weak. Now, the bond short has been just dynamite because it's been where the money's been exiting to go into riskier assets. I would caution those that are excited about this that the fact it broke this support may be the same kind of fake out we saw last week with equities. I would not, if this thing crashed, it could get down as low as 125, 126. But today's dip beneath that support may be just like last Tuesday's equity dip. And that could be the same middle finger to the bond bears out there that we equity bears got last Tuesday. So just food for thought. I read that TLT has been down 7 days in a row. Doesn't happen that often. 7 days in a row. So a bounce back on this wouldn't be that shocking. Let's wrap up with a few E-minis here. Here's the ES, up 0.08% right now, basically unchanged after the close. And at the very top of this very, very big range right now. The NQ is even more interesting one because it has gone so far. We are at levels that are identical to before the tumble even happened. We're at the levels that we're seeing for the first half of the year quite comfortably. So the NASDAQ has been a lot more robust than the S&P. As far as the euro goes, which is really what it's all about, I pointed out this morning that this and this are, kind of similar. This is a much larger pattern even, but I am watching this red line here at, it's not coming up right now, but whatever level it's at, about 1.394 or so. This is very important. Actually, I'll look at it right here, 1.3937. Good guess. I'd like it to stay underneath that if you don't mind. But a weakening euro would aid a weakening stock market. Doesn't guarantee it. As a Sloper pointed out today, equities surged in 2010 in spite of a falling euro, but couldn't hurt. And finally, the dollar via UUP right here. It was sky high last week. It's lost about half of those gains. Wouldn't be a bad place to base right here. If we can lift off from these levels, it would portend good fortune for equity bears. There are some good stocks out there on the long side. Most of them tend to be kind of bounce plays. One, for example, I traded today was none other than Sprint. But this is in like junk bond land at this point. It's very volatile, very dicey, so not something for a buy and hold. So let's see what happens with Europe. But we are way at the tippy top of the range right now. If things continue pushing higher, it could be a game changer. Otherwise, it's just range play, and will continue to be so. That's it from me, and good night.